Those who failed to learn from their mistakes are doomed to relive them. Hello, my name is Pete Stolzers. I'm the founder of One Option, and these are 12 common trading mistakes you should avoid. I've been in the business for over 30 years. I've traded professionally for a hedge fund. I've managed thousands of retail accounts when I was the senior vice president of a brokerage firm. I've seen everyone go through the learning curve as the founder of One Option. My members have gone through a lot of these issues, so hopefully by covering all of them, you'll be able to reflect on what's happening within your own account and you'll be able to improve your own trading. The dirty dozen is what I'm going to call them, and the top of the list is no game plan. Of course, I had to use a guy looking at a map. This is usually me, thank God for GPS. I'm not one to always try and get my directions before I leave, and I always feel like I know exactly where I need to be going. But if you don't know where you're starting, you don't know where you're going, you don't know what the obstacles might be, you're not going to have a game plan and you're not going to know what to do once you've entered the trade. What is my market forecast? What do I think the market's going to do? It drives every single decision. 75% of all stocks follow the market, so you better know what your market forecast is. You better know it for the day, the week, the month, as far out as you can possibly forecast it. When should I enter the trade? What is the optimal time to enter it? Is it at a particular time? Is it a particular price? When should I take profits on the trade? What is my target? How far do I think this stock is going to move? And what am I basing that decision on? Am I basing it on past movement? Am I basing it on upcoming resistance levels? Am I using some type of mathematical equation, a Fibonacci? Am I using an average true range? Where am I going to be taking profits? You should know these things. Maybe it's just a certain profit level that you're looking for that happens to fit into your trade management. Where is my stop? How will I know when I'm wrong? This is a really, really big one because people have a very difficult time admitting when they're wrong, but this is the line in the sand. When the stock goes here, I know I'm wrong. I have to get out of it. It didn't do what I thought it was going to do. What's the trade duration? Am I doing this as a day trade? Am I looking to hold this for a couple of days? Is this something I'm going to have on for a few weeks or a month even? You have to nail down that trade duration because that's going to determine how you structure the trade. How much should I risk? Is this a really volatile stock where I need to do fewer shares, but I'll make the same amount of money because the movement is big? Is it a grinding stock that really tends to be very consistent and just inches its way higher? These are very, very important characteristics that need to be included in your game plan. For those of you who follow me on YouTube, there's a video that I posted on 7/12/20. I gave everyone a swing trading options pick and I went through the process. Here's a chart that shows that exact setup. So I had a stock with a really nice horizontal support level right around the 1440 level. This is also right where the 200-day moving average comes into play. And the stock had recently broken through horizontal resistance. It had broken through the 100-day moving average on heavy volume, and there was a horizontal breakout from that point. So my game plan on this would be the market's stable, looks like it wants to move higher on a daily basis and a weekly basis, meaning for the next few days to the next couple of weeks, the market should be very stable, so I don't have to worry about getting the rug pulled out from underneath me. I've got this nice breakout. My expectation is because of this breakout and this long green candle closing on its high, that the stock is going to continue to rally higher. Where's my target? What would be a logical target profit? Well, this $21 level was prior resistance. That's a nice $2 gain, almost a 10% gain on the stock. Where's my stop? Well, I want to see this horizontal breakout preserved. So if you were a very passive trader, you could use that as your stop, but you're not giving yourself a lot of breathing room. I think the 100-day moving average makes more sense. So the 100-day moving average was my stop in that case, and it's about halfway up this long green candle. So that's how the trade was structured. It ended up being a very nice trade. This is a trading Game plan. Fixation. My precious. People get so fixated on an individual stock that they lose sight of everything else that's going on. Apple would be a classic example. Constantly have people asking me, what do you think of Apple? What do you think of Apple? What do you think of Apple? Apple could be dead flat as a pancake, and they'd still be asking me about Apple. I want to make sure that when I'm trading a stock, I'm looking at as many stocks as possible and that I'm using characteristics within those stocks that help me find the best candidates. Apple might fit that list at certain times, but other times it won't fit that list. I'm looking for heavy volume. I'm looking for a breakout through a resistance level if I'm trying to get long and if I feel that the market's going to go higher. Those are very important to me, and relative strength. All the other indicators that you might use in your trading, those will help you identify the best candidates, so you cannot be fixated on one individual stock. The S&P 500. I like to trade E-minis. E-minis is all I trade. That's the best thing. I have to tell you, there's not really a big edge to trading S&P 500 E-minis. Do I trade it? Yes, I do. I have a particular indicator that I use. Took me a long time to develop it. I have an edge in trading the S&P 500, but even then, I'm still better off trading individual stocks than trading the underlying index. Options. Fixated on options. It's as though options were just invented. Nobody else knows about options, and that's where I'm going to make my millions. Options are simply the icing on the cake. They are not the cake. If everything else is lining up, the market and the stock, then you have to look to the options, but there better be really good option liquidity. So I see lots of people, oh, I only trade options. Fixation, the strategy. They do the same strategy, whether it's iron condors, and you see people plugging away with iron condors and they make money consistently for 5 or 6 or 7 months and everything seems to be clicking along, but they're not watching the market conditions. And then all of a sudden, they get blindsided by a huge market move and they lose everything, excuse me, and then some. So fixation is definitely another problem. If you find yourself zeroing in on a stock and you don't want to look at anything else because this is it, then you need to take a step back, take a deep breath, and reevaluate and take a look at all the possibilities that are open to you. There are thousands of stocks that probably there are at least a handful that look better than the one that you're currently considering. Overexposure. Yes, and this is what I usually get when someone's overexposed on a position and the position is going their way. I don't get the panic phone call. I don't get the panic text. Oh my God, Pete, what am I going to do? What am I going to do? And I've had positions on, my members have gotten into, and we could have 4 or 5 positions on. And as soon as one starts to move against us, I get the, what are we going to do? What are we going to do? Oh my gosh, this thing's moving against us. What's the game plan? Well, the game plan was identified before we even put the trade on. But that tells me you've got too much risk exposure, way too much risk exposure on the trade. So, big concentration in one position. This is the one. This thing is going to move higher. It's going to go screaming. I'm going to make $15,000 on this, and then I'm going to be able to go on that nice vacation that I've been dreaming about. But everything tells me that this stock is going higher. That's usually a really, really bad sign, and you're setting yourself up for trouble. You're only in control of a position 2 times during the life of the trade. One is before you put it on, and one is when you take it off. The rest of the time, you're basically at the will of the stock and at the will of the market. Now, overexposure can be the result of not having enough capital. I have a lot of people ask me, can I get started with $2,000? I really don't think you can because you're not going to be spreading your capital out over enough trades. I really feel that you need to have at least $10,000 of trading capital to get started, whether it's trading stock or trading options. And this concentration is going to really, really impact your trading because it's going to be a very emotional trade. Scared money never wins. And if you're dependent on that money and you have to have that money, you're going to be sweating every tick. Overconfident, I've talked a little bit about that. Oh, all these analysts like the stock and everything's coming up roses for it. So I'm going to plow everything in there and this stock can't go down. Right now we've had a big rally in gold. I personally happen to feel that the market is due for a pretty big pullback, and I have people writing to me, gold is it. Market goes down, gold goes up. No, 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 no. No, it doesn't. So they take a large position in something like that, and then they find out that actually gold is an asset. It may hold its value well relative to other assets, but it does go down. If you ever feel yourself in a position where you're saying, gosh, I'm really nervous about this trade, that's a telltale sign that you have overexposure. Your position is too large. Take some of it off so that you can look at the position objectively. Oblivious to market conditions. This could have been my number one because people take a look at an underlying stock and they don't even know where that stock is within the overall market context. So let's use Apple again. Apple could be a fantastic stock and you are zeroed in on it and it is going higher. But what you don't look at is the overall market. Hey, the market just broke a technical support level. The market's had 3 losing days in a row. The market has had late day selling with follow through the next morning. Doesn't matter. I still like Apple. You need to be aware of what the overall market conditions are. In fact, that's where your analysis must start every day. It has to start with the overall market. What's driving the market? Is there a Fed meeting that's coming up? What are the expectations for the Fed meeting? What big news events? Is it an economic number that's due to come out? Could that roil the market? Why is the market going down currently? Is this going to be sustained or is this a temporary condition? These things need to be evaluated, and there's no sense of direction for the overall market. Trend lines, major moving averages, volume. These are all really, really important. I do about 2.5, 3 hours of market analysis each morning before the market opens. So I have a firm opinion of what I feel the market's going to be doing for the day, for the week, and for the month. Now, the further out you go in time, the fuzzier it gets. So I try and keep my trades inside of 1 month and in particular inside of 2 weeks. That's my wheelhouse. Your wheelhouse might be I see things very, very clearly 6 months out. If that's the case, then you need to structure your trades accordingly. The point is, you've got to know what those expectations are for the market in the next 6 months. Not monitoring the market during the day. For those who day trade, they get on a stock that's super, super hot and they don't look at what's happening with the underlying market. The market could be crumbling and really starting to fall apart, but they buy the stock for a day trade and the market drags the stock back down with it. You end up taking a loss. So you need to have an eye on the market at all times. This is how I have my screen set up. You can see on the left, I've got my stock that I'm doing the analysis on, and on the right, I've got the S&P 500, and both are on a 5-minute basis here. So I know tick for tick what the market is doing constantly throughout the course of the day. And you could be looking at Apple. Oh, I'd love to buy this dip. I want to buy this dip. Yes, we got a nice compression here. See, we had this nice little breakout. Okay, I'm on board. I'm in Apple. And then you start to see what the market's been doing, which is starting to pull back, and you stay in the position too long and you take a loss because you weren't watching what the market was doing. And in my particular case, I've got my indicator that I call 10P as a bearish cross right here, right in here on this timeline. So in here, I need to be getting out of this trade if I was long Apple back in here. That's where I need to take profits. So you must always have a chart of the S&P 500 running so that when you're trading an individual stock, it forces you to be mindful of what the market is doing. Adjustments. I am not a big fan of adjustments at all. Simplicity is the ultimate sophistication. Leonardo da Vinci. I agree with that. Keep it simple, stupid. Adjustments breed bad habits. You're forced to flip flop out of a position. Now I like it. The stock looks really good. Oh, I'm going to buy some. You get into an option position. Let's say that you sell a bullish put spread. The stock is going to stay flat or it's going to go higher. I'm feeling really good about this. Now all of a sudden the stock pulls back. Uh-oh, maybe I was wrong on that stock. Maybe it's actually going down. Okay, well, I'll buy my short put back and I'll just be bearish on it because apparently I was wrong and the stock is going to continue to go down. Now the stock goes back up. You're twisted. You're flip-flopping. Adjustments to me are loss avoidance. It means that the stock has moved against you. Obviously, you're not going to adjust a position that's a winning position, so these are always losing positions. It's loss avoidance. You're trying to postpone the loss. I've even seen traders buy leap options, and they ask me about the trade, and I'm like, do you plan on holding this for a year? Oh, no, 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 no. That way I don't have any time decay. Well, if you went out a month or two, you're not going to have much in the way of time decay. How long are you planning on holding on to this trade? Oh, maybe a week or so. You don't need to buy a leap. What that leap is doing is it's giving you a bailout. You're telling yourself, well, if I get my entry point wrong, then I'll just be able to hang on to it for 2 or 3 months. Sooner or later, I'll be right. So you haven't even gotten into the trade and you're already in a loss avoidance mode. Getting twisted is what I described earlier, where you're bullish, then you're bearish, then you're bullish, then you're bearish, flip-flopping back and forth. You can't admit your mistakes and you complicate the trade. Rolling down and out is a classic strategy that a lot of people advocate doing, and all that does is it creates more problems. So here you've got a nice V-bottom recovery. You've got a beautiful breakout through horizontal resistance. You're watching the stock, test one, test two, everything looks good. Now we've got another horizontal breakout right here. You buy the breakout. Uh-oh, the stock is pulling back. That's okay because this thing's going to go higher. I know it's going to go higher. I'll just keep averaging down. I know that there's some support right in here. Averaging down is also another adjustment, in my opinion, especially if it's not part of your original game plan. These are things that you should plan ahead of on, and they should be part of your original game plan. So, stock pulls back, you average in, you buy some more, and then boom. Oh my gosh, the bottom fell out. Now we have a failed breakout. I'm definitely out of my lungs and I'm short. Yep, this thing's going down now. Now it's obvious. And then you get a bounce. So now you're stopped out here. This is classic twist. When I get twisted on a stock like this, I step back from it and I don't trade it again for a while because these are not normal price movements. And when you do look for stocks, price movements very important. You want to see nice, consistent price movement like this. Once the trend sets in, it tends to follow that trend very, very nicely. Once it reverses, it tends to follow that trend very nicely. When you get into a sideways, herky-jerky environment like this, those stocks you want to avoid, and you want to see, at least on a breakout like this, you want to see one long green candle closing on its high, followed by another long green candle closing on its high with good volume. That's a good setup on a horizontal breakout. Flip flop, just like a fish on a pier out of water. Flip flop. That's what adjustments are to me. You need to take your losses. You need to admit when you're wrong. And especially with a strategy where you're rolling down and out, for those of you who are not familiar with that, you sold a bullish put spread, the stock is moving down, you buy your bullish put spread back for a loss, and you sell one that's farther out of the money, farther out in time, and you try and do that for the same credit. Well, eventually, what you're going to do is if that stock is in a downtrend, you're going to have a position on for 6 months and you're going to keep rolling down and out, spanning earnings season, which that adds a lot of additional risk. And now you've got all this capital tied up in a crappy trade. Think of all the really good trades that you're passing up because you couldn't admit when you're wrong and you had to adjust the position and you had to prolong the pain. Take your losses, get out, move on. Keep it simple. Simplify. Rigid. Way too rigid. Old ways won't open new doors. So you have to always be mindful of new strategies. Make sure that you're reading books. Make sure that you're trying new things. When you try something new, do it in very, very small size. If you're using research reports, see what others are doing. Give it a try. See if it makes sense for you. Same size. My gosh, traders, they get stuck. Let's say you're an option trader. It's always 10 lots. It doesn't matter if the option is $2 in price. It doesn't matter if the option is $6 in price. It's always a 10 lot. You need to think of this as a professional blackjack player. There are certain market environments and certain stocks that set up really, really well. And when those probabilities favor you, then you need to ramp up your size and you need to try and swing for the fence. Other times, you're in a mode where you're waiting for everything to set up, just like the blackjack player. He keeps his bets very, very small, and then when the odds favor him, he starts ramping up his bets. So you need to vary your size. Market conditions will determine that for you. The same stop. I always use a 1% stop or a 2% stop, whatever that stop price might be. It's fixed. It's rigid. I really don't like using that. And I know that a lot of people advocate that. The issue I have with it is the market is different every single day. Stocks are different. You have stocks that have a very high average true range. You have some that have a very low one. So you need to make sure that you're varying your size and you're adjusting your stops accordingly. Same target. If I'm risking 2%, then I need to have a 4% target. Well, what if the market happens to have some huge tailwind and we're getting into a bullish trend day, and here you are capping your trade off at that 4% target, and then you watch the stock run higher? I feel that you need to be very, very flexible. I constantly monitor the market. I constantly monitor relative strength. I constantly monitor the volume of the stock and the momentum. And as those conditions start to change, when they start to change, then I start scaling out of the position and taking profits. But until then, let the stock go, let it run. Make sure that you're not following one rigid one size fits all formula. Same sources. It also could be you're very rigid in terms of your sources of information. So make sure that you spend a lot of time looking at research in lots of different places, talking to other traders. If you're at trade shows, if you're online with them, get into some of the forums, find out what they're doing, but expand your sources because it'll open up your thinking. Greed. This is definitely an issue, and you see a lot of traders who are not paying attention to what the risk reward ratio of the trade is, or they're overstaying their welcome. They're picking up nickels in front of a steamroller, and they're oblivious to what's going to be happening because they're trying to pick that absolute perfect exit point. Well, it doesn't exist. You stay in the trade too long, you're always looking for that perfect exit. Well, here's one way to avoid that problem is scale out of the position. So when you start hitting a target profit, let's say that you're in a stock, it's really put in a good run, exit part of the position. It might only be 20% of the position. Maybe it's 25% of the position. In the age of zero commissions, commissions no longer should impact scaling in and scaling out. It used to be that you would get hit with minimum ticket charges, not anymore. Zero commission trading, you can get in and out at will. So start taking some of the position off. As you take profits in a position, you're going to find it much easier to manage the remaining position. And you'll be happy oftentimes that you have taken profits because then the stock will roll over and you'll think, gosh, I'm glad I got out of some of the position. It'll just make it so much easier for you, and it'll also relieve you of that temptation to wait and overstay your welcome when the bottom finally does fall out of it. And then you're scrambling to hit bids instead of exiting the trade and selling into strength. Now all of a sudden you're at the mercy of the stock and now you're hitting bids all the way down. So scale out of the position. Focus on the reward and not risk. Oh boy, this is definitely a big problem. There are visions of grandeur when you enter the trade. Oh my gosh, this thing looks so good. And if these options go from $2 to $5, then I am going to be a hero. I'm going to be on that vacation. I'm going to buy that car. Whatever those rewards are, that becomes the focal point, not the downside. And the mindset should be, geez, if I lose on this trade, it took me a long time to make that money, and this is really going to hurt me. So you need to make sure that you're always evaluating risk. In fact, I tend to focus on the position risk more than the reward. And if I'm being super cautious with my entry and I'm eyes wide open on the risk and the trade starts to work out, then I can start setting my targets. I can start scaling out, but the focus is not on the reward. When you focus on that, you are in trouble. Get rich quick scheme. Only trade options. I touched upon this earlier. Stubborn, stubborn, stubborn. When I'm day trading, I want to make sure that I'm evaluating opportunities. I'm looking at the stock, I'm looking at the chart, I'm looking at the market. I'm not fixated on stocks that have options on them. And you have to have stocks with liquid options if you're trading, because a lot of the stocks, they have horrible option liquidity. And for some reason, people that want to trade options, I have a suspicion that these people, for the most part, are undercapitalized. And we've already talked about overexposure and the problems that that causes. I only want to trade options. You probably have a $2,000 or a $3,000 account. You probably have unrealistic expectations because you've gone on the internet and you've seen people touting 200% return, 500% return. I've had people come up and tell me in the course of a year, 50%, that's as much as I can expect to make on this strategy. Why would I do anything and only make 50%? So I think there are unrealistic expectations built into option trading because people can see it's fast money, it's big money, but they don't realize the downside risk to it. Options are cool. A lot of people don't understand options, but I understand options. This is a secret weapon that they think that they have that nobody else knows about. Brokerage firms right now want to do option business because there's backside to that. They get paid a lot when they sell that order flow. This is a huge revenue source for them. So they love people trading options. There was a time back in 1989 when I got started in the business, you couldn't find a brokerage firm that wanted to do option business. In fact, you had to jump through hoops just to get an account open and to get your level of approval above spreading. So right now, options are so cool. They make so much money, unrealistic expectations. Liquidity is ignored. When I find a great stock to day trade, I look at that chart and I ask myself, do I know what this stock is going to do in the next 15 minutes, in the next hour, the next 2 days, whatever my time horizon is? If the answer is a resounding yes, you bet, I'm going to buy the stock. If I'm day trading, I get 4-to-1 margin. What more leverage do you need? The other thing is that the stock is infinitely more liquid than the options, because think of how many strike prices there are in the options. When you're trading options, you're almost always trading against a market maker. If it weren't for the market makers, there wouldn't even be a bid and an ask in the options. And it's all done through auto quote. They don't budge. For you to try and get a fill in the middle is very rare unless it's a super liquid option and you're trading against other retail traders. You're not going to get filled. You're not going to be able to buy on a bid. You're not going to be able to sell on an ask. But if I'm trading stock, I sure as heck can buy a bid. I sure as heck can sell an ask. The other thing is think about how many stocks are open to you because you're not pinned in with option liquidity. Lots and lots of opportunities, thousands of stocks. But if I look at stocks that I could day trade options on, there may be 100, maybe 200 that have liquid enough options to where I'm not giving up a huge edge in trading them. So now all of a sudden, I'm very limited in terms of how many different opportunities I can be looking at. And I'll guarantee you, if I look at those 200 stocks, I'm going to be able to find another stock that has horrible options on it that actually sets up much better. This is about making money consistently. This is not about hitting the ball out of the park each and every time. So I think that only trading options is a huge mistake for a lot of traders, and I tend to see it in novice traders who want to get rich quick and who are undercapitalized. Don't know how to short. Man, I have been through so many episodes with this at conferences. I have people coming up to me. They are the next stock guru, the next market guru. And gosh, it can go through every cycle, whether it's the late 90s or 2005 to 2007. You talk to these people and they know everything. And I ask them, well, how long have you been trading? Oh, I've been doing this for 2 years and this is what I'm going to do. I'm going to be a pro trader. I already am. And then I look at what the market's done in that time period and I realize, they've only traded a market that's gone up. They only know one side of the equation. They don't know how to short. And there will be opportunities for you to short. Those people will continue to buy dips. They will continue to buy dips because that's what they're programmed. That's been where their success is. And they're, again, oblivious to what the overall market is doing. I know if I keep buying dips and averaging my price down, eventually I'm going to make money. No, when the market trend has changed, you need to shift as well, and you need to know how to short stocks. And by making sure that you are viewing the short side of the market, you're always aware of when conditions are changing because you're not just looking at a stock from the long side. You're trying to play devil's advocate and you're saying, well, I like the stock because it's done this, and this. But on the other side of the coin, I don't really like this and this and this. And having that balance is going to help you identify better opportunities. It's going to help you identify changing market conditions. You should always see everything from two sides of the coin. And then when you get a big market breakdown through technical support, all of a sudden, then you need to shift gears and you need to be comfortable with shorting. For many people, it's a very uneasy feeling. At very least, if you haven't shorted before, what you should do is learn to go to cash and not to trade. And you have to be steadfast in that belief. Cash is a position. So that might be a way for you to ease into it or do 5 shares, do 10 shares, but get used to having short positions on. It'll help you identify those really big warning signs. You won't be tempted to continue to average down. No, the market's going to go up. The market's going to bounce. It always bounces. You should also know that the market goes down. And there's an old market adage, the market takes the stairs up and the elevator down. So when you get these gigantic drops, they don't tend to be sustained for long periods of time. I'm talking a year or 2 years, because you've got the Fed continually pumping money into the market, and you've got a lot of money sitting on the sidelines. You have fewer shares outstanding because companies have been buying back shares. So there are a lot of forces that gradually grind the market higher. So when you do find situations where you need to be short, the only time you'll get a sustained market decline is when credit is involved. So if you get a credit crisis, you can expect that this is going to be a very long haul, because it's going to take a long time for the economy to recover. But most of the time, you're just getting a natural correction from an overextended rally. And this would be a classic example. As a trader, I know I've got this upward sloping channel, and when the market broke out, through the upper end of this channel, we had a parabolic move. I knew that the sentiment indicators, everything was telling me that we were going to get a market pullback, and we were going to get it soon. So this was a time to go to cash, to take profits on positions. We still had a nice strong uptrend. Everything looked good technically, everything looked good fundamentally, but this was a chance to take some chips off the table. Then the market pulled back, and then it started to find support, and then now we could get long at much better levels. But it's knowing the danger signs and seeing both sides of the coin that will allow you to identify these changing conditions. Lack of effort. Boy, if you think that you get to start your day when the market opens and you get to close the books when the market closes, I've got news for you. If you're doing this as a professional trader, my day starts 2.5, 3 hours before the market opens. I'm looking at all the news internationally that's going to be impacting the market. I'm doing my technical analysis. Then I'm starting to take a look at stocks. I'm trying to see which stocks are going to be leading the market rally. Are there any tangent plays? Do I have any positions in these stocks? Then the trading day opens up. Then you're basically executing all day long and evaluating market conditions on an ongoing basis. But when the closing bell rings, that doesn't mean that my day is done. Once the closing bell rings, I'm going through and I'm looking at each and every one of my trades that I did. I'm trying to see what went right or what went wrong. So you've got to be all in on this. You've got to continually do research. You have to read as many books as you possibly can. The shorter your time horizon, the more you'll be focused on technicals. So make sure that you've read a lot of books on technical analysis. If you're looking to day trade or you're swing trading for a week, 2 weeks, 3 weeks, 4 weeks, the shorter your time frame, the more you focus on technicals. If you like to invest, then you need a longer term perspective. Then the fundamentals become much more important. I'm not oblivious to what the fundamentals of a company are, but I know that my focus really needs to be on the technical side of it. So I'm going through and I'm looking at all of my trade logs. You can really learn a lot from your trade logs, and you need to go through each and every trade. You need to look at why you got into the trade, what your game plan was, why you lost money on it, what you failed to recognize. The other thing is that if you think you're going to work just during market hours, you're not going to be considering new methods. You're not going to be exploring new ideas. You've got to put the time in. My week is about a 60 to 65 hour week during the summer. The rest of the time, I'm probably at 70, maybe even 75 hours per week. So this would be an example of a trade that I did recently. It was on Goldman Sachs. I felt that the stock was weak relative to the market. And you can see this is a SPY chart on a daily basis, D1. You can see that we had that red line is a longer term upward sloping trend line. And we had a shorter term upward sloping trend line. Market's going higher. There's nothing that tells me that I need to be short. I had some intraday indicators that were telling me that a shorting opportunity was setting up. And here we've got a failed breakout on Goldman Sachs. You can see earnings before the open. Stock sold off pretty hard on the news. Failed breakout, and now it continues to drift lower. We have a downward sloping trend line. Market's been going up. Stock has been going down. This is relative weakness. Now all of a sudden the stock has broken a major technical support level. That pink line is the 200-day moving average. Okay. There's relative weakness on a daily basis and heavy selling. So I have the market going up, and on an intraday basis, I feel that Goldman Sachs has been weak on a daily chart. There might be a shorting opportunity intraday. So now I'm going to zoom in on a 5-minute chart. Again, Goldman Sachs 5-minute chart on the left, SPY on the right. So I see that the S&P 500, I've got my indicator right here. Everything starts with the market, 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 market first, market first, market first. I can't pound that into my head and everyone else's head enough. We're using stocks as a surrogate market position, and we've got an edge to that trade. So in any event, I've got a market decline right here, and it's showing me that I can short intraday. Fantastic. The market starts coming in. I've got long red candles closing on their low. I already know that Goldman Sachs is a good candidate to be short. So I'm looking at the relative weakness in here. I'm looking at it breaking below the low of the day. Had a little bit of a gap down here. All right, so I take the short position right here. Now all of a sudden, I get this big bounce out of nowhere in the market. I wasn't expecting that. And what I really didn't expect was I didn't expect the stock to bounce that much. I thought Goldman Sachs was relatively weak. I expected to maybe move a little bit higher, but then to flatline because there was selling pressure. Sellers would take advantage of that little bounce and they would sell, 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 knock it down. I'm trying to lighten my position in Goldman Sachs. It didn't happen. And so as the market rallied, we had this little bounce here, and the stock bounced. Now all of a sudden I knew I was in the wrong side of the trade. My stop was going to be that opening gap right there, which was preserved, so the stock never got through it. But I immediately put a bid in to buy back that short position at my entry price. And when the market has its next little dip, I'm going to buy the stock back. I'm going to scratch the trade. I'll be out. And that's how I handled the trade. But that's the type of analysis that I would do after hours. I would go through and I'd look at exactly what my motivation was for getting in the trade and how I handled it, how I managed it. Was I doing it effectively? Was there something that I missed? Was there something that I could have been doing better? Now, mind you also that because the market was in a longer term uptrend on a daily chart, when I was shorting, I knew I was trading against that uptrend in the market, so I had to reduce my size. But this is the type of analysis that you need to do after hours that'll really make a huge difference in your trading performance. Look at every single trade. Outside advice. Boy, there's a lot of snake oil being peddled out there right now. It's one of the reasons that I have one option. It motivates me to continue to publish educational content like I'm publishing right now. Don't trust anyone. Don't trust anyone. Don't trust me. I don't want you to trust me. I want you to learn what I'm doing. I want you to take my lessons and I want you to incorporate them in your own trading. But as soon as you start listening to someone else, and heaven forbid you get onto one of these sites where they start touting, oh my gosh, we've made 100% on the last 3 trades. You don't see any track records on my site. I've decided I don't want to have any kind of track records out there. You want my track record? Watch my videos. Watch how every one of the trades is panned out in these videos. Then you'll know what my track record is. But you're missing the point as well. When people come in and they take the trial for Option Stalker, some of them come in and they just want to poach trades. I'm going to see what they're trading in the chat room, and for the next 2 weeks, I'm just going to follow what they do, and I'm going to make $1 million following them. That's not how you're going to succeed. Because if I decide that I'm not going to be publishing education and research anymore, you're high and dry. You've learned absolutely nothing from the experience. And you won't know how to find these trades on your own. You really want to take the opportunity to learn systematic trading approaches. Why did they get in? How did they find these stocks? What are the criteria that they use for entering and exiting the trade? You want to learn how to do this yourself. The people that come in and take full advantage of the free trial, they're looking at the stocks that we post in the chat room, but instead of entering the trade and then watching every tick, they rip the stock apart and they go, why did they like this stock? What was it on a daily basis that made it so attractive? What was it on a 5-minute basis that made it so attractive? What was the market doing at the time that they placed this trade? Why did they get out of this stock at that particular price? Why was their stop down here? Those are all the factors. They're trying to analyze what we're doing in the chat room. And by the way, in the chat room, I've got some really great seasoned professional traders. They understand the system that we have. They have a lot of discipline, a lot of patience, and they're excellent traders. You can see that. They've gone through the process though, and that's what makes this all worthwhile for me also is it's not just about me. It's that other people have learned the system and now I can watch their success and relish that and also watch new people come in and say you're going to go through the same process and if you do it, you'll be able to trade like the other people in the chat room. Learn how to do this yourself. You'll understand what went wrong. If you take a look at your trade logs, you'll be able to analyze it. You'll be able to correct your mistakes. You won't be able to do that if you've got a guru who's pulling all the levers and making all the decisions. And if they were a guru, there's a saying that I love. If you're so damn smart, why ain't you rich? Why are you peddling all this stuff? Why are you selling your research? Why don't you just trade it? Well, for me personally, you could say the same thing about me, and I think you should have a healthy dose of skepticism in anything that I say or anyone else does because then it's eyes wide open. But I'm really trying to teach a systematic trading approach. I've got a free ebook. I have a free trial. I have free trades that I publish daily in my videos on YouTube. I am giving away so much dang content because I want you to become a better trader. I'm not charging anybody anything. I have videos on my website. The point is yes, I've got a tool set. So if you understand and you like what we're doing, then you can come in and yes, the tool set has a cost to it and there's a purchase price to it but there's no long-term commitments. So I feel that I'm very open and honest about everything, but I'm really trying to hand you the keys to the car and have you drive it and have you understand how to get into trades and how to get out of trades because that's ultimately where you're going to find success. When you follow somebody else, it's your bailout. I lost money because they told me a bad trade. No, you need to take responsibility for your own actions, for your own entry, for your own exit, for how much money you put into the trade, whether you made money or lost money. And when people tell me they've made a lot of money with my research, I congratulate them. This is not anything, that I did. You had to pull the trigger. You had to manage the trade. I showed you how the setup worked and when to get into the trade and when I got out of the trade, but the rest was all on you. So make sure that you are not following any outside advice, that you're learning how to do this on your own. No system. That's another big problem. Where do I get my research? What is the routine? I have a number of sites that I've set up and I collect raw data and I do my own analysis. I pick up little bits and pieces of information over the course of 2 hours, 2.5, 3 hours before the market opens. Where do I get my research? What are the most reputable sites? And I don't want any market bias. I don't want you to tell me if the stock is going up or the market's going down. I want you to provide me with information and I want to be able to evaluate that information and make my own decisions. And then it's a matter of forming your opinion. How do I form my market forecast? How do I form my opinion? Once I have my opinion, what I believe the market's going to do over that time frame, whether it's a day, a week, a month, that market opinion is going to drive all of my decisions. How much capital do I put into each trade? What type of strategies do I use? What's my confidence level in that market opinion? Once I have the market opinion, how do I drill down and find the best stocks? What are the characteristics? What are the qualities within that individual stock that make it so attractive? And it could be a MACD indicator, it could be stochastics, it could be volume, it could be breakouts, it could be trend lines, anything. Whatever your system is, whatever you've devised, you have a number of criteria and a number of check boxes. And I know if I mark off all these check boxes, my probability of success goes way up. That's exactly what you want to be doing for each and every stock, each and every trade. And then before you put the trade on, where is my stop? Where is my target? What edge do I have in this system? And for me personally, I've got an edge that I developed in my 1OP indicator. It's what I use when I day trade. And in this particular chart, you can see it's one indicator. It took me 10 years to develop, but I know when I have a cross like this off of a deep trough, it's an opportunity to buy. And this is the S&P 500. I've got a long green candle closing on its high, small little pullback. Half of this long green candle has been preserved. Long tails under body. This is an entry point for me. Really nice trade. Market starts to compress in here. I've got long tails under body, so there's some support here. I've got an upward sloping trend line. Now I've got a bearish cross. I have to be aware that the market currently looks like it's going to be selling off. I've got a breach here. This is a nice rally. I'm not going to take a short here. Yes, I would short below that. So now I'm shorting stocks in here. Now I've got a bullish cross down here. Nice bullish cross, downward sloping trend line. Time to buy stocks. Ride it higher. 1OP not telling me much of anything. This is how it works. That's a system. So now that I know what the market's going to be doing intraday, how do I find the best stocks? Well, for that, I use option stalker searches. And I know what each and every search looks for, and I know when to use them under what market conditions. So then I enter the stocks and set my micro game plan up for that individual stock, always while watching what the S&P 500 is doing on a 5-minute basis. That is a system, and that's the type of thing that you need to develop to become a better trader. It's routines in the morning before the market opens. It's a method of monitoring each and every one of your stock positions. Is it still doing what I expected it to do? And then going through and finding new opportunities and managing each one of those trades. But having that routine, having that process, and knowing what your edge is critically important. So I hope that this lesson is something that you're going to be able to look back on, and you're probably doing a lot of things right, but there may be one or two items in this dirty dozen that really resonate with you. So try and break down whichever components those are. Try and learn from your mistakes. Don't repeat your mistakes. Keep trying to move forward. If you want to see how we do it on a real-time basis, I offer a free 2-week trial. You'll have access to my chat room. You'll be able to see our trades real time, and you'll also have access to Option Stalker Pro. So you'll have all of the different searches that we have available. You have the 1OP indicator and everything else that we offer. Thanks so much for watching. I hope that this lesson helps to make you a better trader. Thank you. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.